So hello everyone, today we are going to break down some Nifty option chain analysis, and we understand the four key points, major market movers, and it reveals whether you are a beginner or expert levels. We are going to discuss about this kit to Nifty option chain analysis today. So most of them have previously attended this webinar, and we are going to discuss about the complete overview about this option chain analysis. So if you are new, so let us start from first. I'm not going to take so much time in going all these details in detail. So we are going to discuss in another webinar which discuss about the complete overview about what is this option chain analysis and where we are getting this data and everything. So let's get into this concept, kit to Nifty option chain analysis. So I think most of the users have the access to go through this option chain analysis here. So let me give you some quick idea about what actually we are doing on the background, what is happening, how the data is floating into this Nifty option chain analysis. So we are doing a Python script where we take all this data from the API from the brokers, and using this Python scripting we take this data from API, and this raw data will be shifting from Python scripting to this Google Sheet, where you can have some raw data as you can see. So I mean most of the layouts which are in highlight, which doesn't require your attention to get into all these details, but I'm just giving you an idea of what actually happening in the background. So as you can see on the screen, so this is the raw data which all the brokers, I mean even the data what you are seeing on the screen, which is not a complete raw data, the raw data is completely different, which we can see in the coding area. But here we are taking those information and making sure we can have the all the LTPs and volume and open interest, all this data has been loaded in this format. And even in the raw data also we have so many data which which floats from this API, and all this call contracts will be loaded in one area, and the right side you can see all the put contracts are loaded in the right side. So that's how we segregated the data, and from this data now this data has been transferred into this kit to Nifty option chain data layout. So here the raw data has been transferred in this location, and with our calculations and with our experience we have identified few formulas and added them into these areas. And I mean even in if you see the graphical representation of our option chain analysis, it will give you some quick idea about what is happening in the option chain analysis. Let me say, like if you are saying the open interest, like change in open interest, volumes, LTPs, what you name it, and we have that information in the option chain analysis. So let me hide this. I don't think so we need to focus much on this raw data here. So if you see this Nifty option chain analysis on the right, on the left side we have this calls and put information shown. So generally if you refer to any of the option chain in the market, the process would be the same. Let me go back, go to this NSE option chain. So this is the default interface of the option chain analysis from which is provided by NSE, and there are other few platforms which shows you some great information about option chain analysis. But the beauty in our website is like, if you see this here, it is more or like the same raw data, which if you are an experienced option trade analysis, for you I think this, by seeing the data itself you can identify what is happening in the market. But when it comes to, if you are a beginner, if you are at the beginning level or some intermediate levels also, our data gives you some clarity about what is happening in the market, and we also give the trend analysis in each and every trend. So let's this is the introduction about our option chain analysis. Now let's get into deep and understand what is calls and what is puts, and also I will tell you some beauty about our option chain analysis also. So as you can see on the screen, so this is our YouTube channel, where you can find all these information already loaded into our YouTube channel on a daily basis. And in our YouTube channel recently we have also taken up this 21-day challenge. On a daily basis I am going to post you the challenge, since 21-day challenge is one of the crucial thing for our option chain analysis. So basically, as you know, even SEBI suggested like 90% of the traders used to fail in this 21-day challenges. So that's how earlier they used to give us a certification if the person who is going to at least gain at least 1 or 2% in our daily trades, they are going to get a certificate from the brokers, saying that because the 21-day challenge, making yourself profitable and at the end of the month, is very crucial, because all the time, because option chain analysis itself is a big subject, and trading in options is a very big task actually, because it all involves with money, emotions, and many other things. So most of the time 90% of the traders used to fail in this segment. So we have taken a challenge, and open challenge, and we are doing it in YouTube with 21-day challenge. Let's see how that is going to flow. I think now we have completed around 15 days challenge. I think one or two trades has been gone, but we are at very good shape actually. So I'm expecting at least so in our last meeting we also discussed about 1 second. Yeah. So in our last meeting we also discussed about the winning strategies. So basically our intention was to do this 21 trade is like we have taken around 15,000 capital as a reference. This is only for the only for our reference to identify how well our option chain analysis is working. So if you see the 21 trades, our intention was to maintain at least 15 to 25% at least on an average. So in that case, in our 21 trades, at least we need to win 13 trades, and if even though if we are losing 8 trades also, we are at least getting monthly 25% of our appreciation in our capital. So though we are not we are above the 25%. Let's see after 30 days, maybe around 21 trades. Let's see. I mean, I will give you the complete picture about all the trades, how much profit or how much loss we have taken in each trade. So at the 21 end of the day, 21 trade, we'll see how the things are happening, and I will give you the clarity. But whenever you're going for an option trading, I suggest always refer to this win and lose scenarios. Always don't be so much greedy about the percentage. Always start with small percentage. Even though if you are earning 5% in a month, that is also good enough, including or excluding all your taxes. I suggest start from 5% monthly, so that if you go with any of the ChatGPT or any of the Perplexity researchers also, even big investors are not even gaining 45% of a monthly subscription. I mean appreciation. So we have to be in such a way, like at least if we can able to achieve at least 25% in our monthly percentage appreciation, that would be very helpful. And also let's not discuss about 25 percentage here on a monthly. If you can increase with all your checklist, I mean if you can follow all the rules what we have providing here as a checklist for the option buyers, this I'm not encouraging the option buying here. We also have option buying and option selling in our in our Google sheet. Our 21-day challenge is we have taken only for the option buyers. We can also do it for option sellers also, because most of the time in our option traders, in option traders, all the time option sellers are going to win the trade, since they are putting lot of premiums to enter the contract. So all the time we have to think it in option seller approach, not in an option buyers, because option buyers are the persons who always lose money in the market. Now this is our layout here, option kit to Nifty option chain data. So as you can see here, so the left side you can see the calls and puts, and all the strike prices are noted here. So the call, all the contracts which are building on the call side, you can see the data floating here, and even the put side also we can see the data has been loaded here. So let us get into detail about what is calls and what is puts. Let me give you some quick introduction about what is the Google sheet and how it is working. On the right side you can see the market is closed. So this is an automated Google sheet. No manual intervention has been involved in this area, so everything is fully automatic. I think someone wants to join. So on the right side you can see here the market is closed. So this is also a fully automatic approach. So where starting from 9 to 9:15 you can see an option called market pre-open, and this is the call side and this is the put. And when the market is closed after 3:30, automatically you can see this option has been changed, and it turns to a red color. And when the market is open, you can see the name here shown as automatically as market is open, and the expiry info. So the presently each and every option for any of the indices, either it is Nifty or Bank Nifty, every index has its own expiries. So as of now, Bank Nifty has monthly expiry, but when it comes to Nifty, we have weekly. So we are going to discuss about yes. So as you can see on the screen, so these are the complete overview about the open interest and change in open interest and volumes on both the sides. As you can see, the call side, we have identified all the open interest built in this entire contract, and change in open interest also has been calculated, and we have taken the cumulative volume of entire call contracts has been taken in this area. So when it comes to this area here, this is our major intention, like where you can identify the signals for our option chain analysis. So based on this data, and you can see the time, automatically the time every second it is going to change here. As of now, this is not the market time, but you can see the time will be changing automatically every second. And when you can see the buy option. So here, based on this analysis, so with our calculations, so it will automatically identify which contract you have to open. So whether if the market is in bearish, automatically you can see the P option shown as PE buy, and the strike price and the LTP, and what is the what is the indication whether you wanted to go with a strong buy, or it is, if it is like range bound also, we can see that option directly here. And this entire segment is for option buying, and the last cells we can see this is for the option sellers. So though the persons who are using this Google sheet, the few people used to use for option buying, and few of them use for option sellers as well. So we have provided both the cases. So if you are an option buyer, you have to look only these highlighted areas, and if you are an option sellers, always try to use only the selected areas. Now we can also see the trends, whether it is a weekly trend or an intraday basis. So on a weekly trend, our data automatically identified it is in a bearish segment, and intraday also, based on the analysis, it gives you the analysis here, whether if it is a bullish or a bearish. Automatically you can see this data automatically changed in these approaches. And when it comes to this paid trading, so we will automatically identify complete overview of this option chain analysis, and we will identify the top open interest build in which contract on the call side. So there is no need to identify, go and hunt in this option chain. So if you are a pro expert, automatically by seeing this open interest, by seeing this number itself, we can automatically identify which is the top open interest build in this option chain analysis. But if you are at a beginning level, and it's not about the beginning, it's also about the time consuming. So if you directly go and review the option chain also, it's like it would take some time to identify what is happening in the market, though if you are a pro trader also. So we are trying to cut down those timings and gives much time concentrating on those areas where you can identify what is happening in the market. Like we can also see some other areas as well. So we are identifying the top call interest strike price, what is happening in 24,700 strike price, what is the price for that one, and what is the open interest for this area. And also you can see this is the volume. And when it comes to the put side, we can also see the same 24,700 is the top open interest building in this area, and the price for that put side. And we are not only concentrating on the top one open interest for both the call side and put side. Now we are also concentrating on the top 5 call side and also the put side. And we recently developed this new option where we can identify the spike detectors. As of now, this is a manual approach which is completely running in my hand, but in future we can also make it fully automated. For every 5 minutes you can see the data will be changing here. So we are also going to identify the spike detector. In the intention was to create this one, like when you are in the trading, if you notice some big movers who are actively participated in the market, for say our spy detector is identifying around, if the person is carrying some very big capitals in, like say for say like 15 lakhs or 20 lakhs, it automatically identifies in the option chain and gives us an indication. Like as you can see here earlier, the open interest for any of the particular put side was around 73 lakhs actually, but when you see here, automatically we can see 57 lakhs, which is a very big movement in the market. So that's how automatically our Google Sheet identifies the spy detection, so that more people added into the same trend. So that's how we can identify. As of now we can see the market is in bearish segment. Based on this data, as of now we got an additional signal saying that additional 50 lakh contracts has been added in the same direction. So if it is in a bullish segment, automatically our spy detection will also convert into bullish segment, and also it gives us the same approach. And we also calculated the match span here, and which gives you some PCR indications. So on the bottom side we also have few layouts shown, so you can directly go to this layout and you can see what is happening in the match span calculation here. Match span for open interest and match span for the change in open interest. And we also have a signals uh, in this area, where every 5 minutes you can track what is happening in the market and how the signals are working also. So no one is going to manually change any of these values, since it is a fully automated. Only thing is we need to completely fully automated, where no one will enter this any of this value. Every 5 minutes you can see the time intervals as well. Every 5 minutes you can see the price will be changing. So if you see at 10 o'clock we got an indication like PE buy at 148 rupees, and we can also see sometimes data will not, I mean fully automated approach also will not work. So at what time you are taking the call, that is more important with all the checklist. Then see, one person's approach 10 o'clock will be working, and some other person will have 10:30, some other person will have 11 o'clock. I mean we are not going to give you any time entry or at what price you have to enter, what is the stop loss and what is the target. We are not going to entertain those things. We are only giving you the data with a purely educational purpose, so you can have complete picture about what is happening in the market with the theoretical knowledge. As you can also see, we are also giving the back shoulders method, which gives you the correct price of the any of the contract. Like if you see the call price also, we can identify this is the actual, as per theoretical knowledge this has to be 57 rupees, but based on the demand and supply, the price has to be around 87 rupees. So it's all about demand and supply. And we recently also created one new decay calculation for both the CE and PE. So here we can also have price movement for every minute, every 1 minute. So this is for every 1 minute. When it comes to signals, this is going to take it for every 5 minutes, but for the decay calculation for CE and PE, we are going to calculate for every 1 minute, so that if you are an intraday trader, so that would be very easy for you to go for a trade. So if you see here, so as of now these signals has started. So we can see the P. Let us start from 10 o'clock then. So here on the put side we can see the decay has been increasing, I mean the decreasing. So automatically our graphs will tell you what is happening in the decay on the P side, also in the CE side. So it means the decay of the call side has been increasing. That means the market is showing as a bullish segment. So that's why even in our signals also, the when you see the put price at 148 rupees, though it is not working, if you see up to 10:30 or 1 hour, our data was not even working with this approach. Why? Because the market is in bullish segment. I mean might be there are few, I mean open interest and also few other instances also might happen. But if you see this indication when it comes to decay, maybe around 11 o'clock I guess, I will also mention the timing in this area, we can see a crossover in the decays. So this is also one kind of a checklist. When if you are an intraday trader, all the time I suggest also take it into consideration for the decay calculations also. Decay calculations adds a major role in our trading activities. So if you see, whenever you see some crossover in the decays on both the calls and put side, automatically we can see some big movements in the market. So I'm anticipating maybe around 11 or 11:15 we got some movement in the crossover in both the call side. Let's see in the signals now. If you see from maybe around 11 o'clock we can see some big movement happen in the market. So starting from 109 we came up to maybe around 180 or 170. It's a very big movement we have noticed in the market. Now the main agenda of creating this meeting is to discuss about option chain analysis. So what is short calls, what is long build up. Now let us take with examples. So I'm expecting everyone can participate in this discussion. If you have any doubts, let us discuss in detail. And so this meeting is only for to understand the long build up, short covering, and long unwinding. All the time you might be seeing in these areas, right? So though we are giving you the color representation, you also need to know what is happening in the market. What is short call, what is long build up, you also need to understand, right? So let's get into discussion, and if you have any doubts, let me know. So now let's discuss about long build up. So what is actually happening in the market is we have to identify what is long build up, what is short build up. So let us take some example here. So if Nifty is trading around 25,000, right? So when the price is increasing, when the call option 25,000 call price is increasing, and also the open interest is increasing, that means when we see both the price of option prices and the open interest is increasing, that means it shows a long build up. It means most of the traders are buying at the present price, saying that they are expecting the price can go much higher than what the present price is trading at. So all the traders are very bullish at the market. So when we say long build up, it means they are directly buying the contract. It is about the long build up means we have to consider in a buying approach. So like say the price is increasing, the open interest is increasing, that means that is a long build up. So even if you notice in call side or put side, the concept would be the same. Long build up can be happen in both the side. So long call means we have to consider in the call side. Long put means, as you can see on the screen, long put means both the thing, I mean we are seeing the price has been increasing and open interest also is increasing, that's why we got as a long put. When it comes to when it comes to this one, open, I mean if you see the open interest indicator is increasing but the price is decreasing. So this is a different approach again. So let us come by one point by point. So I hope you understood this approach. So if price is increasing, open interest is increasing, then either it is call side or put side, we have to understand the both scenarios. So let us complete the call side here. If the price is increasing, open interest is increasing, means on the call side we can see the market is in bullish segment. In the same approach in put side, on the right side, if you see, if the put prices are increasing and open interest is increasing, that means long put means all the time when you see green color in this side, that means market is in bearish. If you see red color in this area in the left side, automatically we have to identify the market is in bearish segment. Now I hope long build up is clear. If the price is increasing, open interest is increasing, long build up, that means naked buying. Every trader are expecting the price will move from the present trading price. Now let's discuss about short build up. Short build up means if the price is going down but the open interest is increasing. As you can see now, what is happening here, the price is decreasing but the open interest has been increasing, that means this is a short build up. So our names are a bit different here. So I want, since I have different calculations in this area, I'm going to show both for both the calls and puts. My naming would be different, but this is as per the theoretical knowledge. So we call it as a short build up. Short build up means the traders are selling at this area and they are expecting the price is going to fall much further. So here, as we can see, the price is decreasing, open interest is increasing, means so we have to understand they are building more contracts. We have to understand short build up in seller's point of view. Earlier we discussed about long build up is like a buying approach. People are buying at the present price and that's why we can see price is increasing and open interest is increasing. But when it comes to short build up, we need to understand, if price is decreasing, open interest is increasing, means option sellers are directly entering in this area. So for an instance, let us take one example here. So if you see, as of now the market is around 25,540 570 rupees. So 24,005 for 550, we can see a short call has been shown, which means the open interest has been increased but the price has been decreased. That means lot of new contracts, new option sellers are entering in these calls, saying that if you see, when the option sellers are going to enter in this at the same price, since they seems to be market is going to fall much further, so they are putting so much of premium to take one contract. So we also need to understand here. So if they are building short build up in this price, they are expecting their price can go much further, much further. So 24,570, they are expecting, they might be expecting 24,400 also. So that's how we need to understand. So short build up means, if we also always need to understand in option seller point of view. So they are building a contracts, so saying that, so when they are building a contract, we can automatically see open interest for the contract is increasing. So what they are increasing, they are increasing the contract, saying that the price will go down, so that's why the prices are falling. So in this area we have to understand. So we have covered up the two options now. One is long build up, which means price is increasing, open interest is increasing, then our main strike price will increase. This is purely buyer approach. Now we'll discuss about short build up. As we discussed, now open interest is increasing, price is decreasing. That means this is a seller point of view. They are expecting the Nifty is going to decrease. So the first option, Nifty is going to increase, they are predicting in that way. In the second option, short build up, they are expecting price will decrease. So now let's discuss about third option, short covering. If price is increasing but open interest is decreasing, now we will discuss in different approach. If price is increasing, open interest is decreasing, that is what we call it as short covering. As of now we cannot see that option in the call side. Let's discuss about the put side here. Now we can see short covering has been happened. So it means to say that, so if price is increasing and the open interest is decreasing, so they are closing their positions. Even this, all the time when you see option chain, any of the strategies, all the time you have to think in only in seller point of view. Now if someone, maybe around 25,000 20,000 25,000 contract someone has built up, right? They wanted to they wanted to square off their positions. So what they will do, if you, for an instance, let us take a few example here for a better understanding. Let me take one example here. So if I am taking 25,000 contract, I am an option seller. Okay, I have taken around 100 rupees as an option premium. Okay, as of now I can see the price is moving around 24,500. So if what I'm saying, if price is increasing, if price is up and open interest is up, so what we are going to discuss, first option, if price is increasing, open interest is increasing, means long call. So they are expecting, this is a live price, let us assume this is a live Nifty price, okay, which is 24,500, but we will take one contract here. So I will be taking a new contract here, one with 75 lots, and I have taken 24,500 strike price here, okay, with a premium of 100 rupees. Okay, now I am expecting, based on the option chain analysis, I can see price is increasing and open interest is increasing. That means it is in bullish segment. So I will be taking call side, saying that 24,500 will be increasing. Now in our next time, let us take the different approach now. Now let us discuss about short build-up. Short build-up. Short build-up means if price is if the price is going down, but the open interest is increasing, that means the same approach. Now if the price is going down but the open interest is increasing, so what I'm doing here, I'm squaring off my positions here. Okay, you understood, right? So I'm square whatever the contract I have created here. So I got a I was anticipated that 24,500 from the present Nifty price, our price might go above. But what happened, all the price, no one can predict the market, so automatically I can see some bearish movement has happened. So what I'm going to do, I'm going to build another contract here, so that the price will be going to decrease. So now let us discuss about the third activity now. So short covering. Short covering means if the price is increasing but the open interest is decreasing. So this is the first option. We are an option buyer. Our second option shows. Now let us discuss about the short covering. Short covering means if I am an option seller, I have created a contract. I came to know the market is going much deeper. So what I will do, I will square off my position. So in option sellers, if any of the option sellers squaring off their position means they are giving an option to buy. So if I am an option seller, if I am creating a contract, if I am going to square off my position, what it would be, it will automatically create a buying opportunity in the market. So if you see, if someone is squaring off their positions, that means though we can see the price is increasing but the open interest is decreasing, that means they might have created a contract at this location 25,250, but they noticed they might be eaten all the premium. Now they again wanted to square off all their positions now, and building up some short movement in the prices. Now again they will be entering in another contracts here. So short build up means if the price is increasing and the open interest is decreasing, means option sellers are squaring off their positions. Now let's discuss about both the conditions. Now long unwinding means if open interest is decreasing and also the price is decreasing. So we can also see such conditions here. So you can see long liquidation issue. So what is happening, no of the trader has an interest to trade in this particular strike price. So they are squaring of their open interests, they are squaring of their contracts. No one is entering the new approaches here. So as of now you can see the volume here. So the volume itself is saying no one is going to trade. Even if you put some new buying opportunity also, even if you want to take one option buying opportunity also, you can't see any information who is not going to sell also, because the option itself is not created. So there is no volume, there is no price, there is no contracts available in the market. So now let us also see in this area. So if you see 26,100, these are like low liquidity area where we can identify by seeing this option itself. So 2020 2025 means divided by 75, that means only 27 lots are trading in this particular strike price. 27 lots is very small price, it's very small quantity. But if you see at the money area, what is the, let us see what is happening at the money area. 24,570, 24,570, let us take this one. Okay, which is around 1063666725 divided by 75. See the contracts for one single strike price, we have around 1 lakh 14 lakhs kada? Okay, we have around 14 lakh contracts built. So let us assume how much money has been floated in this particular strike price. The LTP of this one is around 141 rupees. So 141 rupees. So this itself is around 19 crore, only this particular strike price. So people are trading around 19 crore money in this particular contracts. So all the time whenever you go for a trading, all the time you need to see some good liquidity and volumes, so that we can understand. So let us again take some example. I think we have covered up all these four areas: long build up, short covering, long unwinding. Again let us again rewrap the same conditions here. Long build up, means if the open interest is increasing, if the price is also increasing, then automatically we are suggesting our main strike price is going to increase for some time. Let us assume, since the market is bearish segment, so all the put side is in the green area, so let us consider as of now this is a call side. So for a better understanding, because if you are very new to this option chain, if I am talking mostly about put side, you would be confusing. So let us think this is call side and market is in bullish segment. Let us now take that examples. Now if the price is increasing, the open interest is increasing, long build up has been happened, so they are expecting the Nifty price is going to increase from 25,000 to some much higher price. Now let us come with short build up. Short build up means you have to come to the other side. We don't have any short build up happened in the market. Yes, we can also see here, if you see, the price is going down but the open interest is increasing. Yes, this one. If you see, the open interest is increasing but the prices has been dropped. That means there is some bearish segment. Though we can see, it also depends on the supply and demand. If you don't have any good open positions, if you don't have any as of now, you can see short build up, short put. Why we have got it means, we have zero liquidity and only one person is going to sell and one person has to buy. So when you go deep out of the money and deep in the money, we get all these kind of fun issues. So always we suggest go with some good open interest and volumes, so that when you enter any of the trade, automatically it is easy to enter and it is easy to exit also. So we can discuss short build up for in this side also. So if you can see, the open interest is increasing but the price is decreasing, so they are expecting some bearish segment. Now short covering, if the price is increasing and open interest is decreasing, if the price is increasing, open interest is decreasing, means short covering. They are covering the option sellers are covering their positions. And long unwinding, completely no one has interest in any of the particular strike price, so everything is zero, long liquidity, no open interest, no volume, nothing, it is dead. So all the time if you see such instance, if you are already entered in this area, I suggest don't trade with market price. Market price will never work in this liquidity areas. All the time we have to play with limit orders. So these are the major areas which we have discussing about this areas about the option chain analysis. By understanding these four segments like long build up, short covering, long unwinding, you can get a clear sense of market sentiments and you can take some very great decisions in your tradings. Even though if you are very good at this four segments, market four sentiments, even this one also will not help you if you are very good at this option chain analysis. So as of now, anyways, we have given all the calculations. I mean, if you are new, automatically if you are a pro investors also, if you are pro trader, I suggest go with this analysis which can give you some additional benefits. But if you are an option trader, all the time I suggest you have to go and understand this minimum basic knowledge about these four market sentiments. So I hope everyone understood. I think in the next video we are going to discuss about option Greeks. Option Greeks is a very good, very big topic. I think I'm not going to cover at this moment. I think we have started around 7:30, I guess. So do you want me to cover option Greeks as well? I mean, if I'm going to cover up all that one instance, I think again you will get confused with these four market sentiments, I guess. So I think in the next video we are going to discuss about option Greeks, because option Greeks is a very big concept and it's a very big confusing topic also. And anyone has any queries in this long build up, or in, like the four market sentiments which we discussed?
Kitu, here very clear, Kitu. And could you please explain only like what is meant by open interest and change in open interest, Kitu?
Okay, so first of all we need to understand open interest. So change in open interest and open interest. Open interest is the contract in a particular day, how many contracts are building in the particular segment. For say, if you see, let us take one example here. So let us take 25,000 here. As you can see the highlighted area in 25,000, this is the open interest. That means in this end of the day we have few particular open interests are building. For say, let us take one example here. So on Monday we have around 75 contracts. So let us not get into quantity for a better understanding. Let us take today on Monday we have around 100 contracts has been built by end of the day, which is open interest. Okay, now on Tuesday we are going to have the same 100. Next day this would be change of open interest. So on the next day, on Tuesday, for an instance, on Monday we have around 100 contracts has been by end of the day we notice 100 contracts has been traded in the market. Now it's not like end of the day, we can also consider change. Open interest means all the time it will fluctuate every second. So Monday end of the day we noticed 100 contracts has been built in the market. Now on Tuesday morning, when you see on the live price maybe around 10 o'clock, you noticed 150 open interest. Okay, but you want to know what is the difference from yesterday open interest to today open interest. By why? Because open interest is always say you the weekly approach, because we are a trader. On a daily basis intraday we are going to build, we can instantly see so many open interests are building, so many open interests are also closing up their positions. But we actually want, if you are an option seller, option sellers are the people who always trade till expiries. So few people trade with weekly expiry, few people trade with monthly expiries also. So we have to understand their approach, not the person like you and me who are doing trading on daily basis. So we have to identify their approaches, because they are putting so much of money and building the option contracts means they are sitting with even if one contract also they have to build, they have to take more than 2 lakhs of their money. But if you are a option buyer, for you 15,000 is good enough. There is some huge difference, right? So if you see on Monday open interest has been around 100 contracts. On Tuesday we can see 150. What is meant by change of open interest? So change in open interest means, so the Tuesday it is around 150. So we are going to calculate like 150 minus yesterday what is the end of the day open interest, which is 50. So we will identify some new additional position has been added into the contract. So if open interest has been increasing, we are identifying with what formula. End of the day we have to take the data from Monday end of the day data, open interest data. So we are taking the open interest data by Monday end of the day, which is 100, and in the Tuesday the open interest will be automatically changing based on the new positions building in the market. So like say it can be 200 also. What is happening? 200 open interest is increasing, and also change in open interest is also increasing. So for say in Wednesday there is some contract showing as 150. Okay, due to some very bearish in the market. So what is going to happen? Till Tuesday we have around 200 contracts. Let us say contracts means, I think you people might be confused. So we have 200 chocolates on Tuesday. On Monday we have 100 chocolates. In Tuesday we have 200 chocolates. So on Tuesday how much increment has been happened? 100% increment. But when it comes to Wednesday, we have around 150 chocolates. 50 chocolates has been sold off. That means there is some bearish segment we can identify. We can see open interest has been decreased, and change in open interest is also decreased. So what will help you is open interest means we can consider this as a weekly basis, because all the time open interest will not give you some quick changes in the market. But if you are an intraday trader, on a daily basis you are like a you are going to buy at morning and you are going to sell it on the same day. For you people, change in open interest will be helping you. So based on the yesterday analysis, you can identify what is happening in the market. I hope I have answered you, I have clearly explained you the approach. So let me know if you still have any query, I can tell you.
Thank you, Kitu. We are clear. And
You are
could you please explain about like maximum pain calculator, Kitu, and like a PCR indicator also, uh, which is included in our checklist.
yes.
PCR indicator and maximum pain calculations.
Okay, fine. So as you already know, we are going to have some checklist in the option buying. Specifically, this checklist is only for the option buyers. So these are the main checklist which we are identifying. We also have few collected few more checklist in the areas. As you can see, no trade from 9:15 to 8 a.m. This is a cooling period. As we also mentioned about PCR signals. So first of all, we also need to identify what is match span calculations. So match span calculations means, so if you are an option seller, see, all the time match span is only which will directly tell you match span open interest 24/700. That means these are the option seller price. So if market is trading around 25,000, what is now as of now we know market is around 24,500, right? As per the live price, what is the live price? 24,570. So 24,570 is our live price. But what is showing in the open interest? They are showing 24,700. So what is the difference between the present match span price and this one? Around 130 points. So you mean to that the match span open interest is saying you match to match market by end of this week, maybe for this week expiry, for this week August 7th expiry, most of the option sellers are sitting at 24,700. So all these people who are trading below 24,600 and above that one, everyone is going to lose their money. So as you can see here, 24,700. So 24,700 contracts is the highest one who has option writers. So these are the writing interest. So if the price is going above 24,650 also, they will not allow you to go up to 24,700. Why? Because if 24,700 crosses, all the option writers will lose their money. So all the time you already know option writers will win the market. So by identifying, whenever you are creating a strategy, if you are creating any strategy in the market, you need to identify below 24,700 whoever taking any of the contracts. Even if you are taking some positions on 24,700, you might be thinking our prices will go above, but no. Even though if you are option buyer or anyone, all the contracts will be converted into zero only until or unless if the market is below this one. So match to match, these we have to identify like a option sellers. So 24,700 is the support for that one, which they are anticipating that will not cross our market, even though it's like a daily basis. So tomorrow again the match span will change based on the present global news and everything. So most of the time match span means what is the highest amount which doesn't make any value by end of the day, by end of this particular expiry. So that's why if you see, we are going to give you a value of the call values, value and put value, total value. We will calculate all the value, and we will see who will be losing much amount in these areas. I hope this is clear. And don't worry about open interest, because open interest is something on a intraday basis. So I just given you some idea for open interest, but make sure you always follow match pain open interest for if you are following any strategies, or if you are an option seller. I suggest match pain would be better reference and very good reference for you to go for any of the trades. I think even math spin also has some bit more explanation. I think that would really take some time, but for a better understanding, people who are trading below or above these prices, or for that contracts who doesn't have any value, so match to match which contracts is going to lose money, that amount we are going to see it in this area. So that means option writers are sitting at this 24,700 contracts. So that means in the call side, if you see what is the open interest, 24,700. So if you see, we let's see in the call side now, what is the present price, 24,570, 24,750. That means even we can see lot of contracts has been built in 24,750 and 24,900. So these people will not allow you to go prices above this 750 or 900. 900 is a bit okay, but they will not allow you to go above 750. If they are going to, if the price is coming nearly 24,760 also, again they will they will they will build so many open contracts at 24,750, so that the demand supply will take into the game, and again the end of the day market will try to close at 24,740 or 730. You have any other queries apart from this match pain and four market sentiments?
No, Kitu, thank you. Now we understand that maximum pain calculation is like one of the checklist while taking calls.
Yes, even if you see in this indicator also, we are also showing that indication in the PCR indicator, where we are showing the match pain for open interest and also for the change in open interest, and automatically we can identify if the PCR is above 1.4 or 1.2, automatically the signal will change, as you can see here the bearish segment, and we also given the
Okay.
calculation. If it is below 0.75, automatically it will show you the bullish signal in this area. So that's how so this is a this the agenda of this meeting is to discuss about this option chain analysis and the four market sentiments and also the match pain, and in our next coming video we will discuss about Greeks, because most of the time if you are an option buyer, you have to know what is theta, gamma, vega and rho. So that is the main, if you are an option sellers, this is like a bible. If you don't know what is theta, delta, gamma and vega, I don't think so you should not trade in the option chain, option trading itself. So this is a very big concept and very good concept also. Even if you are an option buyer, if you wanted to carry forward your positions, you need to know what is delta and what is gamma, how gamma is going to affect the delta, and what is theta and what is vega, and what is vega means what, how we have to identify IV values. So all this we are going to discuss in our next coming video. I mean, if I'm going to discuss all this at one video, I think if I'm going to discuss about Greek calculations, all my four market sentiments and match pain calculations, everything will go on, because this itself will take some time. Let us take some examples for our better understanding. So I suggest everyone follow some strict stop loss when you are entering in the market. I strongly believe always keep stop loss in the market, enter the money areas. And I also wanted to tell you one more thing. So you can see the LTPs was shown in this area. If you are a safe trader where you don't want to see some big movements instantly in the market, I suggest go with some other prices. As of now, when you see these prices 24,700, it always show you the at the money prices. That means if the market is trading as around 24,500, 570, that means 24,600, it will always show you at the money or near to out of the money. It's maybe around one contract after our at the money area, you can see the highest open interest. But if you are a safe trader at you and you don't want to see some big movements in the market, always I suggest you go with some other prices, where we have identified some few more other highest volume building areas and open interest. You can also trade with 2500 and some other contracts also apart from 24700. So if you see at the money, since we can see some good IV means implied volatility, which has some great percentage. If you have if the IV is more, all the time where we can see IV is more at the money area. So if you see, even in option chain analysis, you can see what is the at the money area for our Nifty option chain. As of now we can see 24,550 is the at the money area. What is the IV? It's around 9.59. But when you go to out of the money, you can see the IV is increasing. IV is increasing means most of the time you might be knowing delta gamma. Delta means for every 100 rupees increasing in Nifty, if the delta is showing as zero point 0.5, zero point 0.5 of our option price will going to increase. That is the theoretical knowledge. But IV adds a major role in price increasing also. If 1% is increasing, automatically we will know in the option that is what the Vega adds into the comes into the picture. So if the IV is increase, if the IV is more, the prices will act more instantly, and the prices will move very frequently. So if you are a safe trader and you don't want to see very big price movements, try to go with some in the money areas. Don't go very deep in the money. I suggest at least go with one or two. Don't go more into deep in the money, because we will have some liquidity issues. So try to understand the IV also when you're trading in the market. If you are having high IV, most of the time people ask me why I'm giving stop loss and why it is going to hit very quickly, because of IV. If you are having high IV, even though I'm giving you the so if you see, though we are seeing the LTP and the indication has been given in the even in the signal area, but if you see the IV is more, IV is more means automatically it is not only taking delta as a reference, it is also giving some additional inputs to the price. By you only don't take only delta as a reference, also take my price, IV also as a reference. So IV will give you more price premium. That means IV, how IV is calculating more or like demand and supply. So if you don't want to see much price movements, I suggest go some in the money area. Don't go to out of the money. So since out of the money, because people always trade in out of the money, because the prices are very low, people always keep interest on this out of the money areas. I mean, they will quickly enter and they will quickly lose their money. So all the time I suggest always trade in the money area and at the money. Even at the money is also good enough. Even if you see at the money also we don't have that great IV. Okay, I suggest go with at the money also. Always try to in our presently in our option chain analysis we don't give any IV, since we don't give respect as of now. Since if I'm going to include IV also, the API is taking too much of burden. So slowly in our upcoming sessions and in upcoming improvements, we are also wanted to involve IV also into our key indication in our option chain analysis. But IV adds a major role if you are an option trader on a daily. If you are an intraday trader, I suggest always look into these IV values. I hope everything is clear, and if you have any doubts let me know, or else we can wind up this session today. You have any doubts, anyone?
No, Kitu, we are clear.
Okay
Thank you
then.
very much.
Okay then. Okay then. Thank you so much for joining on the Sunday. I hope I might have disturbed your weekend. But our intention was to make everyone educated about this option chain analysis, and we wanted to make everyone aware about market analysis and for a better trading. We don't want people to lose their money. Always we try to give some importance for education. Try to understand option chain analysis, which will really help you and change your it will end of the day we want everyone to change their trading approach. So always trade safe, don't be so much greedy, I expect everyone end of the day keep a challenge at least for 1 month, even if you are an option buyer or option sellers. Keep some systematic approach. As you know, we have taken some checklist, so we are running in a good shape. If we are running in a good shape, I think everyone can run, everyone can be profitable. I'm not encouraging the option buyer option sellers. This is an heavy risk segment, but if you are if you do analysis and keep yourself in a systematic approach, I think everyone can have some good percentage. And again, I wanted to quickly give you some, again, some insights about here. Always make sure have some discipline in the market. Make a Google sheet, try to create your own Google sheet. Don't go with an emotions. If you are losing the trade all the time, we are not going to identify the market. Even though we are coming up with so many calculations in my Nifty option chain analysis all the time, maybe we will also lose some. There are some conditions in 21 trades, we have lost 11 trades also, like 13 trades also, right? So no one is going to be perfect in the market, but by following few checklists, we are anticipating we might be in good shape. So start from at least from 15%, slowly try to increase it, but don't expect 100% in the market option buying, especially in the option buying. If you are at least good enough to make 45% or 35%, you are a very big trader and you are very systematic investor. So I expect, try to follow these rules. Everyone can expect some good profits in their trading activity. Let's learn together, grow together. Thank you so much and have a nice day.
Thanks, Anna.
Thank you, Anna.